is Bajaj Finance in particular, and we have Pranav Gundlapalli, Senior Research Analyst at Sanford C, Bernstein, to talk to us about exactly that. What's going wrong with Bajaj Finance? Hi, Pranav. Good afternoon. Great chatting with you. Let me first start off by understanding from you what you make of the results. When I'm looking at your note, you're calling the headline numbers strong, but 24% growth on AUM, 23% growth on profit. Thinking about this more zoomed out than the current quarter, do you believe that there is still a long runway for growth for something like a Bajaj Finance, and there shouldn't be much need for apprehension because you have an underperform on it? So I'm trying to understand where that comes from.
Okay, see, I think two things. So one, the immediate cause, the trigger is obviously that the growth estimates have been cut. The guidance for the full year has come down by a couple of percentage points, and credit costs have again disappointed on the higher side. But I think the bigger drivers are obviously those related to longer term concerns. And there are several actually for someone like a Bajaj, given its scale. I think the first one is on the growth. While, yes, the headline growth number looks great at 24%, the concern is twofold. One, the NIM has been flat, indicating that there's a greater growth is being driven by lower yielding segments. And also the part of the growth is being driven by segments like gold, MFI, etc., which are more cyclical in nature and really not the same quality as what Bajaj's core business is. Right? So yes, the headline number is good, but the underlying trends suggest longer term concerns. There are concerns on the asset quality front as well. While the full year guidance has been maintained, the declining provision coverage ratio do indicate or suggest that we might not really see a very sharp decline in credit costs. Or in other words, the credit costs will stay higher for longer. And that again adds to the concern. The third point is simply the slowdown in the franchise growth, right? So there's a bit of a law of large numbers catching up. If your consumer franchise is a large percentage of workforce, the entire workforce, then it's hard to expect that to keep chugging along at 20% plus. So that natural slowdown with size is also showing up in numbers. So put all of this together, and there are several long-term concerns which I think are getting priced in. Net, I think a steady state EPS growth number should be a lot lower than what's probably priced in. And it's that correction which is taking effect in the market today.
Makes sense. Okay, and what about what of the NPA ratios? They've inched up. The management on the call yesterday was suggesting that inch up is seasonal. It's purely seasonality. It's the number of days. Talk to us about what you make of that view, and whether, in your opinion, that's valid, because they quoted the last 2 to 3 years saying that that's been the trend. Give us the sense from your end.
See, yes, there is a seasonality in the business, but on a year-on-year basis, you still see a good 20 bips improvement. And especially when you combine that with the sort of growth that has happened on the AUM front, the NPA increase does look a bit concerning. And combined with that, you see a provision coverage ratio dip, then we do expect credit costs to stay elevated for a longer term. So in other words, about 200 basis points might be the new normal, which I don't think is priced in yet.
They spoke about margins. Now, do you believe that them passing on margins to the customer is a sign of competition, or because Bajaj Finance as a franchisee hasn't ever voiced that? They always believe that we're in a league of our own, right? But do you sense that is also a bit of a concern, if at all it is one, in your opinion?
I think, again, it's the size issues, right? So one, if you need the growth, you need to give up margins, which is probably what is happening. And that loss comes from two fronts. One is obviously competing with your banks, your EMI, credit card EMIs, etc., on the consumer durable side, where there could be some passing off of the rate cut benefits. The other is simply moving on to lower yielding segments like mortgages, right? So both these actions will keep NIM under pressure. And it's partly because of the size. I mean, if you're a small portfolio, sure, you can be tactical about which segments you grow in to protect those margins. But at nearly 5 trillion scale, it becomes hard to do those sort of maneuvers.
140 rupee target price you've given it, Pranav. What's the valuation you're pegging it at? What's the price to book? How many years forward? How are you looking at it?
Okay, our target price is basically based on our view that EPS growth for this business will remain at around 20%, which is very healthy, but that will require a reduction in their price to earnings multiple. So we see most of the decline or the lower target price a result of a lower multiple that we think is the right one for Bajaj Finance, given its current stage of the business.
Multiple are you giving it? Give us a sense of that.
We have a 20 times PE multiple, trailing PE multiple.
Understood.
Versus the 30 times which it is now.
Understood. Yes. And what do you make of the rally? You've been a firm 640 target price analyst, and we've seen a stupendous rally in the stock. What do you make of that? What are the factors that's aiding that, in your opinion?
So we've seen a very sharp rally driven by multiple factors. I think one is Bajaj was seen as a clear beneficiary of rate cuts of the entire consumption boost that was provided through the year. And the other big factor was a continuation of Mr. Rajeev Jain as the CEO. I think that, again, was a big positive. And this led to a rally after a stagnation for several years. Right? So it was a bit of a catch-up which happened once the whole management transition issue was addressed. Plus, you had these tailwinds to help as well. Now, we've been less optimistic on the tailwinds part because our view remains that margin expansion will be hard to come by at this scale. And also the consumption boost need not necessarily translate into credit growth. While yes, it does lead to expense growth, might not translate into a commensurate credit growth. Some of that is kind of what is playing out right now. So our concerns in Bajaj are more longer term around just a weaker earnings growth than what is priced in, and hence a correction in multiple over a period of time or a stagnation. So it either happens through corrections like today or through stagnation. Either way, you should see a reset in the multiples.
And Pranav, the MSME book facing pressure, right? Now, Bajaj itself may not have increased the credit cost guidance, but now I'm starting to trying to unpack the impact on industry. Whenever Bajaj Finance has commented on a particular segment facing pressure, and this time they did comment that there was quite a bit of pressure. What's the sense like? What's the knock-on effect across industry, and what could the possible casualties be? Could it be large for the MSME segment?
I think unlike the consumer side, where banks, NBFCs all play similarly in terms of unsecured, secured, etc., MSME is one segment where most of the banks play in the secured segment. So you don't see a lot of unsecured MSME lending, at least for the large banks. So the pain might not really translate or carry over into the larger banks. So we think it would be limited to some of the large NBFCs, including Bajaj, but not really get translated into the bank side at least. So we don't see a similar stress coming up for the banks, for example.
Pranav, that's all for today. Thank you so much for coming in and having that conversation. Of course, the larger banking industry, I'd love to have that conversation and that chat with you maybe in a week or two. So we'll schedule that as well. But thanks so much for coming in and speaking with us on this critical day.